Good evening. Tonight we will be discussing the overinflated housing market in Canada. Canada is currently experiencing a huge boom in the housing market. Prices have risen in the real estate capitals of Canada, Toronto and Vancouver, by up to 30% in the past year alone. These high prices are beginning to entice the middle class outside the range of a detached home in both of these popular cities. However, the banks have found a way to take advantage of a family's desire for an expensive property by lowering mortgage rates and increasing latency on loans. Canada is currently one of the highest rates of household debt than any other G7 country. This debt is a product of more lenient banking policies that are allowing Canadians to take out mortgages on a house that their income may not be able to support. The desire for expensive real estate continues. However, that desire is only reigniting the inflation bubble in the Canadian housing market. This bubble is a mashup of high household debt levels and overvaluation of properties. If this bubble bursts, catastrophic events could soon follow. Commercial banks and mortgaging firms would quickly demand their credit back due to the lack of monetary funds. This would lead to high interest rates and stupefyingly high bill for families to pay off. Middle-class families may find themselves in a position when they would have to default on their own property in order to appease the banks, leaving many without a home and causing real estate value to plummet. The lack of funds could eventually lead to a national recession. The mortgage industry argues otherwise. Canadian mortgage firms are reassuring the people that the rise in the housing market has helped jumpstart the Canadian economy since the 2008 crisis. They argue that any change in policy could lead to an unnecessary drop in demand and price. They also argue that the growth in prices is due to real business-based growth in Toronto, as incomes are steadily rising as well. This issue brings a challenge to the Canadian government. How should the government use the monetary policy to keep Canada safe from a recession? Well, we have an opinion to offer about that. I believe that the mortgage firms are delivering biased information. Of course they would want the good times to continue. They are profiting off of mortgage and credit. Given the facts and the evidence that is on the table, I believe that Canada's housing market bubble is about to burst, following with rapid deflation. Debt levels amongst Canadians are rising significantly too. The 2008 crash brought poor economic times to America, and household debt had risen too high. This caused people to default on their own properties in order to pay back their mortgage, leading to a sharp decrease in demand and diminishing property values, as well as a diminishing dollar, leading to unemployment. This put America into a recession that had sparked unemployment and left the economy in shambles. Now, I think we can see a correlation between these two incidents. Canada was largely able to avoid this crash as banks had changed their policy on loans and mortgages and had also lowered interest rates. This allowed people to have more disposable income in their pockets, leading to increased spending and a healthy economy, ultimately bypassing most of the American recession. However, when the recession was seen as over in June of 2009, the bank's policies remained the same. Spending on housing began to rise significantly, and the high level of debt and low mortgage rates allowed most of the social classes to get a house, booming demand. However, this increased spending of credit positioning Canadians in the same position that the Americans were in 8 years ago. In 2016, the CBC reported that housing prices have risen up to 30% since 2015 in some cases, and over 100% since 2008. That means that a $500,000 house bought in 2008 would now equivalent to more than $1 million in 2016, with inflation as well. Levels of household debt have also risen in correlation with housing prices, with the debt levels rising to 167% in 2016, up from 150% in 2008. The amount of credit the banks are lending out is unsustainable, and they will eventually run out of money, just like what happened in America. Canada will experience a rapidly growing number of homeowners defaulting from their homes, resulting in an unbalance of supply and demand and crashing the real estate market. This crash would follow with a recession, as the money or credit supply is quickly reclaimed by the banks. The start of a recession will bring an ultimate economic crash to Canada, and with the currently diminished oil industry it may be hard to come back into a state of recovery. However, that hasn't happened yet. With a possible recession in their hands, the government should create a plan of action. They have a chance to turn Canada around before it turns all the way around. The Bank of Canada should use monetary policy to control the commercial banks and raise their interest rates. Furthermore, they should raise taxes on the banks slightly and encourage the banks to lend to families whom they feel are financially sound to take on a expensive property. This would allow the housing bubble to deflate slowly, ultimately slowing the economy but putting real money back into the system. The increased taxes that were imposed on banks would be used in a government rainy day fund in order to quickly level out the economy if the crash should occur otherwise, before the recession after the crash can begin. And if the crash never occurs, this rainy day fund can be used to invest in other infrastructure throughout the government in order to promote more reasonable houses for a social class that can afford it. Once the market has reached the equilibrium, the Bank of Canada can cease the increased taxes on the banks and have interest rates lowered by 50% of what they were raised at. This would prompt slow, stable growth of the economy without overinflated credit being involved. The lower housing prices that would also result should also allow middle-class families to enter the market with a reasonable mortgage rate rather than a dangerously low one. Another part of the economy with Canada is that we may not be able to pull into recovery due to the lack of innovation in our industries. We cannot rely on oil forever, as the industry will eventually diminish. Innovation is needed in our new industries if we are ever to prosper in the future. This includes innovations in technology, automobile manufacturing, and other industries that Canada does best. Thank you for watching tonight, and we hope to see you again soon.